It's an amazing accomplishment to have brought it from where that programming occurred to where it is in the test of time.
I think Bitcoin's greatest risk is its success.
I was going to ask on Bitcoin. I'm not an expert on Bitcoin, but I'll tell you what I think. I'll tell you what I think anyway. Anyways, take it. It's not worth much. Bitcoin has an imputed value, not a intrinsic value, and so it depends what it's perceived as. It's a tremendous accomplishment to have done that programming, not have it hacked, and to have its advancement. At the same time, and so it will have the perceived value that it is given by the marketplace. Now, right now, if you take the value of Bitcoin, you take the price. What should the price be? And since the quantity doesn't change, you know what it's a function of demand. Right now, Bitcoin is worth a little less than $1 trillion. Gold, all gold in existence, is worth, if you take central banks and jewelry out of it, about $5 trillion. So it's about 20% of that market that represents, the hedge market and so on. I think that I think if it's successful, really successful, it's not going to be a lot more than that. And and also if it's successful, there's a risk the government will outlaw it. Well, this has all happened over and over again. That's what caught my attention. When you hit a zero interest rate and you have too much debt, and everybody needs money. The way it works is the government sends out the checks, but the government can't print money. So it has to borrow money from the Federal Reserve and borrow money from others. And they don't have enough money, so that they print the money. And so the value of cash and the value of bonds has negative real returns, significantly negative real returns. And so money goes somewhere else. It goes into, traditionally, equities, it goes into gold, it goes into property, it goes, Same thing happened in March 1933. And that was when they produced a lot more money and that monetization, which moves its way through the system. Mechanistically, the way it works, a bond, the Federal Reserve comes in and buys a bond. It gives it to an investor. That investor then in turn puts it into other investments. And then it gives it to the public through the government. So this is, that's the way the mechanics. I don't think it's well understood. For a long time, the question is, how can communism and capitalism coexist? That's the riddle you have to answer, and he had to answer it a while ago. And what do these people want at the top? And what the answer to that riddle was told also by Deng Xiaoping when he was asked. He said, it's glorious to be rich. And then they asked about capitalism, and he says, it doesn't matter if it's a black cat or a white cat, just as long as it catches mice. And so the idea is producing wealth. And so capitalism, yes, but the redistribution. Okay, so we have four things that are really going on in China, if you understand their intent. Common prosperity is the word now, okay? And there's been the objective to raise money and then to broaden the base of that. Okay, that's common prosperity. So if you look at their tax rates, they're lower than the United States. If you look at the measures of almost capitalism, they have as much capitalism or more capitalism, much more so than Europe, for example. And now they're in a prospect to broaden that. So I think there's a tendency, and an understandable tendency, to think because they are Maoist and capital and communist that they're going to go back to that kind of a thing. Xi Jinping just, for example, introduced the newest stock market in Beijing. He made a point of being the one who introduced the market in Beijing to the small and medium-sized enterprises. They know that it catches mice. And so the issue is that the capitalist is not in control. The issue is that there's a system for the whole system, and then what they want to do is make sure that it's not a capitalist-driven system. So, and then there's data control, and then you have to understand there's micromanagement. It's like the kids, there's a top-down versus bottom-up. Very simply, you have to decide whether the rules and the place is a place that you're comfortable with. They will set the rules, and you go in there and you decide if you're going to be part of that as as a good citizen or you're not. And then, but you don't jump in and out. In other words, China's a strategic play. You're not going to jump in and out. And the amount that you're in should be that which you're comfortable with. It's the same as an investor. It's not smart to sell on the break or buy. It's a strategic play. Most investors are very overweight in the United States or other places. Diversification. There's a competition, a big competition, a war of sorts going on in technology and so on. The diversification, put the amount and the exposure that you want to have there, because you have to have places on some money on two chips, because there are risks in the United States too. The value of interest rates, the impact of interest rates has been largely taken out in terms of the magnitude. You're not going to have that kind of volatility. And if things go down, you're not going to have the same kind of protections from the bonds as you do. It's changed, because then you get quantitative easing. It gets transmitted, so that when you need an easing, you get the printing of money, and then you have the reflation type of dynamic. So that's the way the volatility is transmitted. We've had plenty of volatility in the markets, but not in the bond market, right? Every tightening of interest rates has been less than the one before it since 1980. Every peak and every trough in interest rates has been lower than the one before it. And then when we hit zero, then we did QE, and every QE has been larger than the one before it, because we've accumulated so much debt and that we're now printing. I think that you'll have probably one pullback, and I'll call that a mock charge, and then you set the markets down, because the duration of the bond market and the duration of assets is longer. That means interest rate sensitivity is greater. You have that particular correction, and then you'll have another round of that. And so I think that's the nature of the beast that we're in with. The QE, understand, and that means negative real returns. The things that must happen is that cash is going to have a lower interest rate than bond. What you'll get is a significantly negative real cash rate, a negative and probably more significant real bond rate, and that you're going to continue to have interest rates significantly below nominal GDP growth. In other words, inflation plus real growth. The average thing is going to increase. Let's take nominal GDP. That's production of inflation and growth. You put those two things combined, you would rather own a piece of that, which is a piece of the economy, than you would want to own interest rates. That's the environment we're in.